That's a no-brainer for next week. My guess is that they'll go to 25 basis point hike after that. And again, I'm looking at the symmetry of what they did, right? When they started raising rates, they started with a 25, they went to 50, then they had 475 hikes, and now they're kind of coming down the mountain on the other side with a 50 and likely 25. And I think by the end of the first quarter of 2023, they're basically not hiking anymore. But the kicker is they're not going to be cutting rates either. And I think that's going to be the main elevated, right?
Yep.
And elevated to me means 3 to 4%, maybe 5%. So again, it's already coming down. We know it's coming down. Oil prices have come down quite a bit. That's helping bring inflation down. But the key is does it go back to 2 or under %, which is what the Fed wants? And my answer is no. The wage inflation is going to be sticky. Always keep in mind that when people get paid double what they were making, it's not like that business can double the price of an orange the very next day, right? So it has to be passed through over the course of a series of, let's say, years. And so what's going to happen is you're going to see prices incrementally move up year over year to compensate for the hike in wages that we've seen around the globe. And I think that's going to mean that inflation stays north of 3% for at least 2 years. 50 kind of the guiding to 50, and then you're going to look for 25. And the market is going to like that as long as the economic data doesn't start falling off a cliff.
Right.
All right. If we start to get to that point where bad news is actually bad news, because remember, right now, bad news has been good news because it means that the Fed is less likely to hike when you get that bad news. It means the economy is slowing, so they're not going to raise rates as much. But if we get into that next period where you see bad news starting to become bad news again, then I actually think that it doesn't matter. The market will realize that the Fed's not going to cut rates, and bad news means we're slipping into a recession with no bailout from the Federal Reserve.
Right.
Reflects that. And part of the issue here is that inflation is from the past year. So 12 months ago, how much has inflation gone up? Well, if we go 12 months ago, inflation numbers were already spiking. So what it's telling us is that yes, the inflation numbers are still going up. We're still seeing inflation, but the rate of increase is slowing. And that's what we see in these inflation numbers that are coming back in. And I think that's a common misconception. Everyone hears, oh, the inflation numbers were better than expected when they come in, but it's not saying prices are going down. It's just saying they're not rising quite as quickly. So I think investors have to be ready for that. I mean, it means that the prices at the grocery store are still going to be going up over time, just not as quickly. And it's going to hurt the economy. There's no doubt about it that investors and retail Americans in general are going to feel the crunch in 2023. And remember, since 2009, the Fed has just been printing us out of every trouble. Whether it was, you remember obviously 2009, the collapse in the banking sector, all the bailouts that went on and the quantitative easing that was started. Right. And then that basically continued. Then in 2018, we saw them say, okay, we got to start raising rates. The market threw this big hissy fit, dropped 20% in a matter of 6 weeks. They actually reversed and started cutting rates again. And then it takes you into COVID, and we know what happened during the COVID crisis with them printing even more money. And that was the massive printing of money that we saw. Yeah. And so it's really everything. It's the inflation numbers, it's the economy that's going to be slowing, and it's also just the overall kind of wear and tear that it does on the consumer. Payment. One of the best indicators of the struggles in the housing market. I got back from Boston 6 weeks ago, and I got into my Uber, and it turned out my Uber driver was a real estate agent, right? Yep. So that tells you everything you need to know about real estate right now. I don't necessarily see that same sort of 2008 collapse yet, but it is something we have to monitor, and I think you have to expect that if interest rates are going to remain elevated, then home prices probably have 20 to 30% downside from their highs. Knocks the market down. And remember, the Fed has done that, right? They see the market rallying and they'll say, hey, listen, we're going to be more hawkish, and the market sells off. They don't want the stock market to be up to all-time highs because it creates this wealth effect where people say, hey, look at my 401k. It's worth X amount. I can go buy that new car now. And same thing with home prices. Your home, you bought it last year. You already made 100K on it, and it created this wealth effect. So it's all tied into this inflation that's going on. And I do absolutely think that this is one of the things the Fed needed to pop these bubbles. Now, the question is, can the Fed control the collapse? In history, they haven't done a great job of it. I'm doubtful that they can again. Okay. Minimum of 10 to 15 years. I want to show you some really cool charts here. So
take a look at the charts.
Here's the Dow Jones Industrial Average, and I'm going to show you guys why I'm showing this chart. So take a look at what we have here. You have this sort of pattern, which is basically this M pattern top in 1915 to looks like right around 1921. All right. And again, you're going to say, well, why the heck is Gareth going back to this period? And then look at the run that the Dow Jones Industrial Average had for the next, basically in the roaring 20s to obviously the Great Depression, the collapse, the crash of 29. And so if you look at that, and now let's just go right to the S&P 500. And this is where it gets crazy, right? So what we can see is that same sort of pattern formation from the dot-com bubble, the dot-com collapse, the real estate bubble, the real estate collapse, and then look at the massive run we've had. Now, a lot of people would say, okay, that's just a chart. It's just, it's a coincidence. But what you have to do is you have to delve deeper. And this is where I love being a student of history. And what you do is you look at what was going on in the early 1900s, 1915, 1920s. And what was happening was cars were becoming more and more the norm. Electricity was becoming more and more the norm. Well, what did that give us? It gave the consumer light at night. They could go out at night. They could go to speakeasies, spend money. They could drive more than, before cars, you were limited to the distance you could go if you wanted to go to the general store, right? Mm-hmm. And so you had all these things coming into play that created a consumer that could get out there and spend money. Then look at what the lending stuff was in the 20s. There was lending policies that are very similar to a lot of the lending stuff that we're seeing. Now, if we go to the current times in the S&P 500, in the dot-com era, what do we know happened? The internet emerged, right? And the internet basically gave, do you shop on Amazon?
I do.
Well, so do I. And think about that. Now you didn't even have to leave your house to shop and spend money. And so there's these coordinative factors that make me think that we're very similar to what happened in the teens to the 20s leading into the into the Great Depression. And I don't want to, it's hard for me not to jump to that conclusion, but I am very concerned that we could see something like that occur.
Yeah.
And then if we flip over to the run from the 20s, we're at the end of the roaring 20s.
Okay.
Stock market goes down 50%. Now let's take it a step further and say the Federal Reserve will not be coming in to print money, because if inflation, let's say, is at 4 or 5%, how do they print trillions of dollars with the risk of inflation jumping to 20 or 25%? We don't want to be Venezuela. We don't want to be some of these countries where you have this kind of crazy inflation. So the question is, how do we get out of the next recession? And that's the question. I don't have the answer for that. We might just have to pay the piper at this point. I think we're actually absolutely in a bear market. In fact, I think 2023 is going to be even worse than 2022 in terms of downside in the stock market. But there are places to go, right? There's gold. Gold, again, great performing asset. It's if you look back and compare the 70s and the early 80s in gold, it's an amazing replication of what we're seeing now, yet we just haven't started the big move up in gold that should be coming. So there's lots of places to go. And I would say this is that, in general, long-term investors have had their field day since the Fed began bailing the markets out. It's now becoming more of a trader's market where you buy, but then you can't just say, hey, I'm going to tuck this away for 20 years. You want to actually just take the profits and run and then look to I think the S&P 500 has, at minimum, we're looking at going down probably to, just in 2023, we will easily see the 3,300 level, which is basically the pre-COVID level. So if you go back to COVID, the February of 2020 period, the S&P 500 was trading around 3,300. We've never retraced back to that level. So it makes full sense that at least we'll go down there. That's about a 15+% drop from here. That's the bear bull case. That's the best case scenario per the charts. Really what we're looking at is likely going a lot lower to potentially a trend line. And I'll show my SPY chart here, but we basically could be retracing in 2023 all the way down to about 3,000. I would say 3,000 or just below 3,000 is my kind of key zone for the S&P in 2023.